So this weekend there are two big events that take place that always get my attention. One is the Guineas, and the Guineas is a big meeting that really sort of kickstarts the flat season proper. It's the first classic of the season, but it also clashes with the Berkshire Hathaway AGM that Warren Buffett has in Omaha, Nebraska. And I thought it may be interesting for you to listen to and get my views on passive income, Betfair trading, Warren Buffett, all of those things mixed into one, because there are very clear links between each one of these. And I actually managed to get to ask Warren Buffett a key question about the dovetail between all of those different things. So if you want to learn what that question was and what his answer was, then watch the rest of this video. If you're interested in learning to trade on Betfair, then visit the BetAngel Academy, where you have detailed, structured Betfair trading courses. Or why not visit our website, where you can download a free trial of BetAngel Professional, but also visit the forum, where you can get detailed images, examples, and downloadable files. And don't forget to subscribe to our YouTube channel and click on the bell icon if you want notification of new videos as they're released. So a passive income is defined as a way of earning money with minimal effort and minimal upkeep. And it's obviously a dream of many people. It was a dream of mine when I was young. And the story behind how I sort of learnt about a passive income was through some work that I was doing many years ago. I discovered what a dividend was and what investing was, and eventually that would lead to me meeting Warren Buffett many years later. We used to do a bit of moonlighting. I had a really low-paid job quite a few years back, and the problem that I had with it is that I never really got the income from it that would allow me to do anything interesting, and I sort of felt a bit locked in to what I was doing. I needed a break, basically. It was the upshot of that particular moment within my life. So I used to go and moonlight, and once I moonlighted for a local financial advisor. He was new to technology. He wanted somebody to come in and teach all of the people within his company how to use computers and word processors and exciting things like dot matrix printers, and he wanted a network set up and stuff like this. So I would go finish my normal job and then go around and meet this guy afterwards, and then he would just say, oh, today I'd like you to teach them how to do the following, and I would just give them instruction, give them some tuition, and then return the following week and tidy up the loose ends and the rough edges. But when I was there, I started trying to sort out, I mean, his system was a complete mess, so I was sorting stuff out, and I started going down the list of things and saying to him, oh, you know, what's this thing here? And there was a regular stream of payments coming into his company. And I said to him, what are these? And he said, oh, those are dividends. And I just went to him, what's a dividend? And he went on to explain to me what a dividend was. So income is basically, by definition, something that you yield off of an investment. And, you know, let us try and encapsulate this in a better sense. You know somebody that's invented a fancy new widget. He wants to start his business. So what you do is you have a discussion with him, you lend him some money, and he goes off and rents a local business unit somewhere and starts creating his widget, which turns out to be one of the best things that's ever been created in the universe ever. And all of a sudden he needs to get a bigger factory and stuff like that. So at that particular moment in time, typically time is of the essence when you have a great idea. And you could sort of incrementally grow the business over a very large number of years, and then gradually it begins to take off. Or you go to an investor who you borrow money from, who invests in your business. But of course they expect a return, and there are sort of two ways that you can get a return from a business, or investing in a business or part thereof. And that is that you hope that the business is this size here, and then in 10 years time it's this size here, or maybe even bigger. So that stake that you have within the business will actually be worth a lot more. They invest the money from the business, which creates a profit, which they then reinvest in the business, which creates more profit, and then the process continues onwards and upwards from there. So your original £10,000 stake, the business has grown tenfold and now has a valuation much higher. That £10,000 is now worth £100,000 or £1 million. Or if you invested it in Google, Apple, Facebook, Amazon, any one of those companies, hundreds of millions. So what you're looking at there is capital growth. So basically that is an investment that you make in a business that gets returned by selling an asset at some point in time. So what I want to do in this video is try and split out for you the different types of ways that you can sort of earn money, and whether it's passive or active, and all of these sort of definitions as well. Because it all dovetails in. It will all make sense by the end of this video. So yeah, if you invest in a business and then sell the business, or your share of the business at some point in the future, it will hopefully be worth a lot more. So if you go into the stock market and you buy an investment in a company, then that's effectively what you're doing. So I bought shares in Berkshire Hathaway, which is Warren Buffett's company that he runs, that he's famous for running, many years ago. In the I think it was mid-90s, early to mid-90s was when I bought a share in Berkshire Hathaway. You'll notice I'm using the word Berk instead of Berkshire, which is, I live on the border of Berkshire, or near Berkshire, but in America they pronounce it Berkshire. So that is the correct pronunciation. So if you want to sound clever or stupid, use the word Berkshire when you're talking about Berkshire Hathaway and Warren Buffett. But yeah, I bought shares in Berkshire Hathaway many years ago, and what I was doing then was figuring out that they would be worth a lot more in 10, 15, 20 years time. And of course that's exactly what happened. If you look at the stock price from when I bought them to where they are now, there's been an absolutely massive run up, and that is because Buffett is a great investor and a great businessman. He takes any spare income that he has from his business that has generated in profits in the prior year and invests them in the company, or buys other companies with them. So you get this almost exponential curve, because he's taking money that the business is earning and reinvesting it. And I think that he can do a great job of that. So I've given him my money, and hey presto, that's where your payoff is. Now what you're doing there is that is a sort of passive income, but it's not as well, because what you're looking at there is capital growth. You're investing in something and then selling it at a bigger point in the future. And so what you're actually looking at is a growth in an investment, which is entirely different from a passive income or income from dividends. Because one of the things that Berkshire Hathaway does that is unusual or not common is that it pays no dividend. So typically when you invest in a company, what you tend to do is you give them some money and you'll eventually get a payoff at some point in the future. But for being an investor, they will often pay a dividend to you. So going back to this job that I did moonlighting many years ago, that's what you get on a regular basis. That's what I could see on his income statement. That's all of those ledger entries that were coming through his accounts were dividend payments from companies that he owned. So I also own other companies, such as I own a company called AG Bar, I own Disney stock, and they pay dividends. So basically I'm sat here now, and the Disney empire is running away in the background for me. An AG Bar, you probably never heard of the company, but you probably have heard of the product that they produce, which is a drink called Iron Brew. And I've invested in AG Bar for a very large number of years. So the perfect investment that you can make is one that grows its business overall, so it reinvests its profits really well, but one perhaps that pays dividend as well. So that's the true definition of a passive income there, is a dividend payment from a company that you've invested in. I quite like investing in companies that have dividends, because if you don't think that they can reinvest it in the core business to grow the business at a fair old clip, then they may as well return the money to shareholders, and that's how they do it. They pay off a dividend. So whether I'm here, I'm asleep in bed, I'm out riding my mountain bike, whatever, the Disney empire is working for me in the background, I will receive a dividend from them, or people are drinking, normally in Scotland, are drinking Iron Brew, and that's generating profits for the core company, and they are returning some of that cash to me as a shareholder. So if you want a true passive income, I think that that's the best way to do it. You invest in a business. It doesn't have to be a public company, it could be a private company, or something that pays dividends, and it works a way for you overall. I think it's actually a very democratic way of running a country, because you actually have an investment within companies that have a sort of are involved in the whole mix, as it were. So you expect to get rewarded for that, and you may get rewarded through capital growth, but a lot of companies pay dividends to make sure that you are guaranteed some sort of a return. Now, I could go into great depth about all of that, but essentially, price is what you pay, value is what you get. If you can buy these companies at a reasonable price, then hopefully they'll grow their business, they'll grow the dividends, and that's where you get your return on investment. But I think that's the true definition of a passive income. Now, obviously, I sort of wear two hats really, because I do some trading and I do investing as well. So money that I make from the trading side of things, I will invest, and that's been something that's been a mantra of mine since day one. Any spare capital that I've got that I don't need immediately, once I've paid for all of the other things that are going on, I invest with the intention that, if I don't need the money now, I can park it, take a little bit of risk on the investment, and then get a payoff at some point in the future. So that's been the way that I've done everything for as long as possible. So I do actually have a passive income. I get the passive income typically from all of the investing that I do. But obviously I do the trading as well. And when you look at trading, it's very distinct, or gambling in general, because trading is a more complex form of gambling. You don't have such a thing specifically as a passive income because there's no yield. What you're doing is you're speculating on something. You're basically saying that you know a little bit more than somebody else, and that you will net a profit from there. But the problem is it doesn't actually potentially yield anything. You're just saying that you're better than somebody else, or you're better than the market. I actually think if you strike out errors, or you avoid making really chronic mistakes, you will actually do better than most people within a betting market, because a lot of the money in the betting market, for want of a better word, is fairly dumb. It doesn't do what it should do. It's not rationally optimized, unlike the stock market, which is fairly efficient. But you see, with the stock market, companies tend to grow over a period of time, especially if the economy is growing and the sector in which they're in is flourishing as well. But the gambling market is typically flat. If you look at a lot of the big markets, I measure the top line number, and by top line I mean how much money is bet into the markets over a period of time, how much money is matched on a Betfair trading market. And that doesn't grow the same way as a company. A company that can grow exponentially, it never quite does, because at some point their product that they're offering becomes unpopular or gets superseded, and then the company sort of starts to sort of fade away. But then a new company will come up behind it. So if you get a dividend, you can take it from the old company and invest it in the new. But yeah, that process, that curve continues on for a long period of time. But in a lot of betting markets, the growth is pretty much flat, or sometimes they're into decline. So the problem you have with that is you can't reinvest the money into the market. If the market's been flat for 10 years and inflation has gradually been creeping up, then effectively the market is shrinking. So if you are able to get something out of the market, then you'll generally not be able to put it in, because eventually you would grow so fast that you would become the market. So yeah, I tend to take money that I make from the gambling and Betfair trading, and I tend to invest it. However, there is a sort of way that you can get a passive income, although I'm loathed to call it income, because income for me is a yield on an underlying asset. Whereas really when you're talking about gambling, you're talking about Betfair trading, what you're actually doing is you're speculating. It's you against other people. The market doesn't have a yield within it as such, and it doesn't grow in the same way as a typical investment. So it's your skill, your ability, your strategies, your tactics against others within the market. And therefore I wouldn't necessarily classify that as an income of sorts, because you're just speculating. That's what you're doing. You're trading in and out, and you're trying to take advantage of inefficiencies within the market. If you look at something like matched betting, that is doing it at a very low level. That's basically saying there's a price over here, there's a price over here, there's a slight mismatch, and therefore I will take advantage of that mismatch. So that's arbitrage effectively, but it's still not income. It's still an element of speculation, because a bookie could welch on you, you may have misread the rules, there could be an error, but technically you're looking at arbitrage rather than sort of income on that situation, and that's really more on the speculative side of things. So there's a degree of separation here between like a passive income and something that is speculation. So I think you have to draw the line between the two. Speculation is something that you do where you're thinking about what the price should be, or where it will be, whereas income is a yield on an investment typically. However, I mean, if you look at the way that we've developed BetAngel over a period of time, you can tell that we've pushed it more and more down the automation route. And part of that is a response to many different factors. But also, if you have a Betfair trading strategy or a gambling strategy or something that you can speculate on that does yield something, then why not automate it? Why not get it to run in the background for you? So rather than sort of saying that that's a passive income, it's a sort of a speculative passive income, or it's a passive speculation is probably the correct words to use. So BetAngel runs, it's doing it now actually. There's some racing that started early today. It's active in the background. You can't see it doing it because it's sat on a server. And it's basically active and in that market for me. So I don't know how it's doing, but I know that over a period of time it will probably end up. And this pretty much runs 24/7 for me now. So once you solve a particular problem in a particular market, there's no reason why you can't transplant that to another market. It may not work exactly the same, but if you've got the fundamental basis underneath, then that will actually allow you to run that pretty much 24/7 on a variety of different markets or on certain types of markets, and that will produce something for you. So I often run stuff on events that are running overnight. So BetAngel sits there, does all of its magic, and then I wake up in the morning, and the first thing I do in the morning is get up the iPad, press a button, and hey presto, there are my results from overnight. And it can work particularly well. But obviously you've got to get a lot of work in to get yourself to that point. It's not something that you can just switch on and go, hey, magic. Like the example we gave on the dividend income from an investment. It's something that you need to chip away at and work at, refine, improve, and then deploy. Because obviously if you're going to leave something to run completely automatically, it may be that you have to sit in front of it for a while to make sure it's doing exactly what you want. But that's sort of why we've got the manual trading, we've got the automation, and we've got the servants as well. So you've got the best of all three worlds. You can always progress from a manual strategy to partly automating it with a servant, to then making it completely passive from your perspective and completely fully automating it. So there is a line that needs to be drawn between what you would consider an income and speculation, because one is complete speculation and the other is a form of investment that you would expect to yield in a conventional term. So when I went to the Berkshire Hathaway meeting one year, I actually thought it would be fun to ask Warren Buffett exactly what his thoughts were on gambling, because for me, when you look at gambling, it's a form of speculation, but if you look at the insurance industry, which Warren Buffett is heavily invested in, that was a form of speculation as well. They're basically taking in premiums, which could be their income, and then they're paying out when people make a call on those particular premiums, when there's a major earthquake, a hurricane, or some natural disaster, or maybe you just bumped into somebody's car. Nonetheless, you are gambling effectively with that premium that you're going to achieve a payoff. So I thought it'd be fun one year to actually go and ask Warren Buffett exactly what he thought about, did he feel that gambling was, he's very anti-gambling. It makes me laugh actually when people quote him on gambling videos, because he just does not have anything to do with gambling and will not have anything to do with gambling. But I thought I must ask him why he has that view when effectively the insurance industry is doing exactly the same thing. It's gambling, it's speculating with somebody's money.
Hi, it's Peter Webb here from London, UK. Your views on gambling are well known, and I think most people would agree that gambling is for the physically challenged. But when I look at the insurance industry, I see an industry that's based upon probabilities and people not knowing those true probabilities, and money being made for the house in the same way as you see in a gambling market. So the question that I have for you is, how do you reconcile your views with gambling versus the insurance industry? And is the insurance industry for the fiscally challenged?
Well, gambling, I think the distinction that usually is made is that gambling involves creating risks that don't need to be created. I mean, if you want to go out and gamble on where a little ball is going to fall on a wheel that's revolving, that is not something that is a created risk. Whereas if you've got a home or a business, on a coastal area, the risk is there. It wasn't created intentionally. I mean, say you build in that place, and then the question is who bears it. So there's a transfer of, in the case of cat coverage, large existing risks as opposed to the creation of a risk that is not required. I mean, you can watch a football game without betting on it, but you can't live in a house, you know, on a Florida coast without having a risk that your entire investment disappears. So that's the distinction, basically. I hope you're right that the house wins in both cases. Charlie?
Well, I don't think I can add to that either. The whole concept of house advantage is a very interesting one in modern commerce. A lot of the investment management operations, which were not ordinarily spoken of in the past in croupier terms, but the terms of a lot of private equity investment now, I think the proprietors of the partnerships are taking a house edge that looks a lot like the rake of the croupier in Monte Carlo, except it's bigger.
Is there anyone who's forgotten insult? I'll make sure we don't miss anyone here.
So that was Warren's view on how the insurance industry was different from the gambling industry. Basically, he's saying that there's risk to be mitigated in the insurance industry, whereas the risk is made up in the gambling industry. Now, from his comments, he was talking more specifically, I think, about casinos, because if you've ever watched a football match, you know, and you've ever watched an England match, you're often thinking, maybe I could mitigate some of the risk here by having a little side bet to reward me if everything goes terribly wrong. So I think you are sort of mitigating a bit of risk, but I think his main angle on it really was that it's manufactured risk, and that they're encouraging people to take risk rather than attempting to solve a particular problem, which is fair enough, I suppose. But yeah, I thought it was an interesting question to ask, especially being a shareholder of Berkshire Hathaway, because the two look very similar to me. You accept a premium from a customer, and then you speculate whether something's going to happen or not. And I don't think that's too much different from gambling. I sometimes wonder whether I should have done something in insurance as well. And in fact, I've always sort of viewed a betting exchange as an insurance market for sports risk. I think the idea could have been developed and matured a little bit more from there. But anyway, the point of doing this video is that when you look at the betting exchange market, you're looking at a certain type of risk. It's not the same as something that if you invest in a stock where you get an income off of it, you're purely speculating. And you may profit from that. And if you automate it, then that will allow you to do that in the background while you're busy doing other things. That's like the perfect goal that you could have. And there is no reason why you shouldn't be able to do that, because if you have a strategy that works manually, then there are some strategies that sort of sit more neatly within that capacity, but there are some that sit beautifully within automation. But when you look at the way we've designed the product, it's designed that if you trade manually, then you could probably automate some of it with a servant, and if you can automate some of it with a servant, then you can probably completely automate it. So we give you those three options in terms of how you want to do that. I have stuff running all of the time, and that allows me to yield something even if I'm not at my desk or I'm doing something else. But obviously I can sit here and actively trade as well. But on top of that, I've got all of the investments in things like Berkshire Hathaway and all of the other companies that provide a little bit of an income stream for me as well. And I think that that's a pretty beneficial way of running your affairs. That's probably the goal that you should be aiming for, because I think you could get sucked into one thing or another and find yourself not in the position to be able to do one or the other, whereas ultimately I think if you can have all of those things together, then you've sort of got the perfect scenario. You can have a bit of fun, you can do a bit of trading, but you can also have a bit of income coming in from elsewhere. But I think there are distinct lines to be drawn between running a business, investing in a business, and actually doing some speculation, because you could speculate on the stock market very short term, and what we're doing when you're Betfair trading is you're speculating on a betting market very short term, which I would particularly classify as income, because that would be more related to an investment that you made that you get paid for holding effectively. Anyhow, I hope that's been useful for you. We've covered a number of different topics, but it's something that's popped into my mind, especially as this weekend we're at the Guineas, and the Guineas is always when they have the Berkshire Hathaway shareholder meeting. So the two sort of dovetail quite neatly in between from there. Anyhow, I hope that that video has been useful for you.